John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hello there, this is John Ulzheimer, consumer credit expert. I have, 3 decades of experience in the credit industry. That's over half my life. That's kind of, I've never thought about it that way. Actually, we're going to talk about a terminology that exists in consumer lending, and specifically the topic is upside down. What does it mean to be upside down if you're a borrower? So this is going to apply specifically to loans, specifically to installment loans that are secured. So what in the world is a secured installment loan? So, and first off, an installment loan is a loan where you have a fixed payment for a fixed period of time. Student loans, mortgages, auto loans, boat loans, personal loans, those are all installment loans. And so you're going to, like for example, you may have an auto loan where you pay $500 a month for the next 72 months. Same payment for a fixed period of time. That's, you're paying in installments, therefore that is an installment loan. What is a secured installment loan? All right, so a secured installment loan means that there is some asset, some physical asset that is acting as security for the lender. So using my example of a auto loan from a moment ago, the actual car, the vehicle, is acting as security. So if you stopped making payments on the loan, then after a couple of months, the lender is going to send the repo man. The repo man's going to repossess your car. They're going to sell your car at auction, blah, blah, blah. That's all bad, of course. But the automobile, you can see how it acts as security for the loan. So that's what's referred to as a secured installment loan, right? So that's where you have this issue of upside down. So now let's kind of start bringing everything together, kind of put together some more pieces of the puzzle. And what does it mean to be upside down? When you borrow money against some sort of a physical asset like a car, car's a really good example. The car is worth some amount of money. Let's just say hypothetically that the car is worth $20,000. And let's say that you go out and you borrow money to buy that car, and the lender lets you borrow $20,000. You pay for the car. Now you have the car and you're making a payment every single month to the lender because that is a secured installment loan, auto loan. But we all know that in normal times, the value of cars goes down over time. And normally it goes down pretty significantly soon after you buy it. So you may hear, kind of funny statements about buying a new car is that, oh yeah, I bought it and I drove it off the lot and it lost 20% of its value when I did that. In normal times, that's usually what happens is your car starts to go down in value. But your car doesn't go down in value at the same rate or at the same pace as the balance of your loan. So you may actually find yourself in a position where you owe more on the loan than the car is actually worth. And so let me kind of do some math for you. So in that scenario, again, you borrowed $20,000 to buy a car for $20,000, and now you owe, let's say in a couple of months you owe $19,000, but the car is now only worth $15,000. And after a year, let's say you owe $17,000, but the car is only worth $15,000. So you actually owe more than the car is worth. That means you are, my friend, upside down on that auto loan. All right, you have what's referred to as negative equity. It's normally not that big of a deal because in auto lending, it's almost recognized and accepted without argument that people are generally going to be upside down throughout some portion of their loan. Where it does become an issue is when you want to sell the car. If you want to sell the car, but you actually owe more than the car is worth, then you're not going to be able to sell the car for the full amount that you actually owe. So you may actually have to write a check to the auto lender after you sell the car to help pay off that amount of negative equity, the percentage that you are upside down in the loan. If you trade in your car for a new car and you have negative equity, then the lender is just going to tack on that amount to the new loan. And so you may hear the really fast language they say in in the auto loan commercials, negative equity applied to new loan balance. But they say that so fast that you can't even understand it. Negative equity applied to new loan balance. It's like the micro turbo language that you hear at the very end of the commercial. What that means is if you trade in your car and you still owe $1,000, they're just going to tack that on to whatever the new loan is. And so you're going to be even more upside down in your new loan because of the negative equity. So that's what it means to be upside down on an auto loan. If you have any other questions about being upside down or any other position, drop them in the comment section below and I'll get to them. Thanks for watching. Have a great rest of your day.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.